Welcome back to the channel, guys. Woo! We have got a lot of stuff to unpack. Last week, I put out a super quick video on a major change that took place overnight last Thursday regarding Fannie Mae and Freddie Mac and their decision to increase the costs and interest rates for second home purchasers and investors. Now, this was a hot topic for a couple of months, primarily because both Fannie Mae and Freddie Mac are under a government conservatorship. And that means that they have a contract with the government to make sure that they're keeping sustainable lending practices. And one of the biggest requirements was that they weren't going to exceed more than 7% of non-owner occupant type of financing. And so unfortunately, we have gone well over that as an industry. And because of that, first-time homebuyers are suffering. So that's why the immediate change. Now, one thing that I will say is that it is great news for homeowners, but one of the also negative headlines that came out this week too was that interest rates have been increasing now for the third straight week. And if you look at where interest rates started at the very beginning of the year, they were around 2.65%, and they're now in the threes. You can look up current interest rates on the Freddie Mac interest rate survey, but buyers have definitely lost some buying power in this market. Now, how much specifically? Well, if you're buying a $300,000 house, you can expect somewhere around 3%, which is $9,000 of buying power. Now, that's not catastrophic, but when you're in an environment where people are overbidding for properties, paying over appraised value, you're going to look to figure out how to get that $9,000 from other places, like borrowing from family members or liquidating a 401k, which I don't necessarily recommend. So, to answer the big question that comes next, right, is rising interest rates and this new change, how is it going to impact the housing market? Will these changes slow it down? And the short answer to that question is yes. So yes, we will see a slowdown because the number of people that are interested in purchasing goes down. But I will say that there is such a large pent-up demand of people waiting to purchase properties. We won't even feel this impact for many months to come, and I doubt we'll feel it in 2021. Just to give you some reference on this, the last time we saw a big shift in housing, and a big shift. So there was about to be one at the beginning of 2020, but it never took place because of obviously everything that's happened. But the last time we saw a real shift was back in 2005, right? And that was still known as a boom time. They actually reported that the last quarter of the year is actually when the market started shifting. They didn't even report on it really until 2007. And then for all of you people waiting for a housing crash, the bottom of the market was actually 2011. So such a long period. Now, the differences between that market and this market was that one, there was a lot of people that were non-occupant borrowers, quite frankly, investors and second home purchasers that invaded certain areas. And when the going got tough for the economy, they were the first ones to relinquish properties, which is why this conservatorship agreement is so important to home ownership, right? So they're trying to make sure that that thing doesn't happen again, right? In case of a housing correction in the future. Now, the next question I'm sure you're asking is, oh my God, is she saying that there's going to be a housing crash? Well, absolutely not. But it is nice to know that they are keeping preventative measures from that happening. But a couple of things you have to consider, because I understand why you're waiting for something like that to happen, is that there's still an increase in the number of people that are eligible to purchase now. Average age of homeownership is 33 years old, and those are your beginning millennials, right? And so as that age group continues to get older, more people are going to be emerging into the housing market. Second thing you have to consider is that more people are getting married and having children now, so new family creations are on the rise, right? That's another need for real estate. And that our aging population is choosing to age in place. So instead of leaving their properties to live with family or go into retirement facilities or assisted living, they're choosing to stay in their houses, quite frankly, because it's way more affordable. And like that, they're not relinquishing their housing. So those are three things that are really going against us when it comes to a correction. And so I really just don't see, even with increased housing costs, right, that we're really going to see a dramatic shift because of the amount of people who are going to be needing housing. So I hope that's not a bummer for you guys. One thing I will say is that in case this is not your time, there's so many other things that you can be doing to prepare yourself for, becoming a more qualified buyer, becoming somebody that is in a better position to be a more competitive or write more competitive offers. And that is work on your credit, save your money, decrease your debts, right? Because that will ultimately give you more purchasing power. And then, and also look at other investments, like invest in 401ks, retirements, potentially stocks. There's other ways to grow your money than just real estate. So just do not despair. I promise you there will be a time for housing for you. Now we're going to be hosting a live this Wednesday where I'll be answering all of your questions. So don't be afraid to post and comment below. I love hearing from you guys, and I hope you guys tune in this week.